So bond market is one of the important segments of uh, NSE and BSE market right now. So bond is a debt. So the company has many options to collect money from the public. One of the options we have discussed in the last class, that is through equity shares. Recently, you have experienced an equity IPO issue, the Zomato. The IPO has been fixed, oversubscribed, and the IPO has been fixed 76 rupees it was fixed, but a person who opted for one lot or two lot did not get the allotment because it has been oversubscribed. So the 76 fixed IPO, the price has been fixed rupees 76, but it is listed, it was listed in the market, I think 116 rupees 116, and the prices went up further, and I don't know today's position, but it has went up to 136. So a person who got allotted for rupees 76 and his value was increased to 130. So it's almost doubled. So a person invested 1 lakh. He was in the position, about 2 lakhs right now. So that is a case of Zomato IPO. Even though the company was overvalued, but the investors reacted very positively. Investors are very positive on the Zomato's case. I don't know the reasons behind the Zomato. Zomato is the market leader of online food delivery channel. Maybe that is the reason, because there is no competitors to be next placed in the Zomato. Swiggy has been placed very weak, and Zomato is very big, has positioned very big market share, I think. So that may be the reason, and the future scope opportunities are maybe the reason. And there are many business model run by the Zomato apart from the food delivery. That may be the reason behind the increase in the price of these Zomato shares. So that is through equity shares, and Zomato is now traded in the equity NSE as well as BSE market. So that is one of the source, that is equity shares are one of the source to collect funds from the people. And the company, apart from the equity shares, company can collect fund through bond. So so we can have another investment avenue which is known as bond. So bond is like a debt. It's like a loan. The companies can take loan from the banks, but the company have to service the loans, so that they have to pay monthly interest and the principal amount regularly. Similarly, company take loan from the public. If the company take loan from the public, or even institutions can purchase the bond. If the company purchase loan from the public, which is known as bond, it is through bond. So bond is a type of debt. So we can elaborate bond market. Bonds are the units of corporate debt issued by companies and securitized as tradable assets. The bond are units of corporate debt issued by companies and securitized as tradable assets. A bond is referred to as a fixed income instrument. Fixed income instruments means if a person purchases a bond from a market, from a company, the company regularly pays interest to that person who purchased the bond. So it's something like a loan taken by the company from the people. If we take a loan from the bank, we have to pay interest and principal amount regularly, so that if we take the bond, if an investor take the bond, the company will service the bond in the sense that company will pay interest and principal amount regularly. So there are variable and floating interest rates. There are bond, some of the bonds interest rates are fixed, and some of the bonds interest rates are fluctuating. So bond prices are inversely correlated with interest rate. So that is very important. If the RBI's policy changes on the interest rate, the bond prices are. If the RBI increases interest rates, the bond prices will be decreased. If the RBI decrease the interest rate, the bond prices may be increased. So when the rates goes up, the bond prices fall, and vice versa. That relationship also very important. So bond prices and the bond demand depends on the interest rate policies of the Reserve Bank of India. So a bond is competing with the loan, means commercial banks loan. So there are options by the companies to take loans and options to take company through bonds. So which option the company takes, that is very important. That depends on the interest rate policies of the Reserve Bank of India. So bonds have maturity dates at which a point the principal amount must be paid back in full or risk default. So bonds have maturity date. Bond is like a certificate, and the certificate contains maturity date at which point the principal amount must be paid back in full. So if the bond has a time limit of 20 years, after 20 years the principal amount will be paid. In between the time, bond will pay the interest to the subscriber of the bond. And there is a risk of default also. If you purchased an unsecured bond, if the company is wind up or company has some issues, the company is declared to be insolvent. Such situations, the bondholders face the risk of default. Company is not in a position to pay back the money invested by the investors. That is known as default risk. So these are the basic understanding, basic concept of a bond. So bond market in India. So bond prices change essentially due to changes in the interest rate or interest rate perceptions, macroeconomic factors like fiscal deficit, besides demand and supply. So bond, we can purchase bond from NSE market and BSE market. The bonds are available in the cash market itself. So bonds are also purchased through some of the government bonds that purchase some other bidding criteria or bidding terms are also there. But the bond market is not fully developed in India. The bond prices and interest rate perceptions depends on the macroeconomic factors like fiscal deficit, besides demand and supply. Okay, bonds are quoted on the basis of yield or return. The yield means the interest rate given by the bonds. So that is a main criteria to purchase the bonds. When there are a lot of bonds available in the open market, and the subscribers are also interested in the interest rate fixed in the bond. Some of the bonds are trading 10% interest rate. Some of the bonds are trading 9% interest rate. Some of the bonds are pricing, 8% interest rate. But a person who is intelligent always prefer a bond having 10% or 11% higher interest rate. So the higher interest rate bonds are, that market price is increasing because the interest rate is high. So many people are demanding that bonds so that its price may be up. Okay. So you will need to understand that a higher interest rates bonds are long-term bonds. Okay, and their demand is also more. So there are very few dedicated brokerage houses for the there is a broking house which name is Zerodha. Zerodha is a broking house. Have you heard about Zerodha? Sodhi Kumar sir, are you there? Can you speak something about the broking houses? Zerodha, have you heard about that?
Yes, sir. Yes, I heard of Zerodha. These are the brokerage houses which basically facilitate our transactions. And I'm presently holding. I do my transactions through ICICIdirect.com. So Zerodha is a very popular one because of its low.
Zerodha is very popular and is very interested. The brokerage fees is very less, and they are the broking house which is interested to popular the stock market trading across the country, and they are saying like the stock. There is a time will come up when the parents giving gift to their daughter, and like in the form of a demat account. Okay, after 18 years, they will be started a demat account and offer to the kids for the investment. So that kind of projections by the Seroda. They are interested. There is a time will come up, and the parents uh, offering gift or other persons offering gift in the form of shares or demat accounts. There are very few dedicated brokerage houses for the debt market in India. Our debt market are much smaller than in many countries. But unfortunately, I would say that Indian bond market is not much developed, but Indian derivative market, NSE is the number one derivative segment in the world. NSE is the fourth stock market in Asia. So, but our bond market is not much developed. So that you might have experienced that Kerala government last year, I think they have listed a bond in a foreign stock market. Have you experienced, Sir Sodhi Kumar sir? Can you comment something about that Kerala government bond? And this bond was known as Masala bond. Which stock
Sorry, sir,
exchange?
I'm not aware.
Ah,
I'm not aware about
okay,
it. Yes.
Masala bond, and which was listed in London Stock Exchange. And why this name Masala? The bond was named as Masala bond, and it was listed in London Stock Exchange. And the fund was collected, and it is been used by the Kinfra for infrastructure projects. And why the government, Kerala government, is not interested to list that bond in NSE, but they have interested to list that bond in London Stock Exchange. So that was interesting, and that bond was very popular, and bond was named as Masala bond. Why? Because and Kerala is a place for the spices, so that the bond was named as Masala bonds. So that's the story of Masala bond. So an Indian company or an Indian government or Indian agency can have the authority to list bond in the foreign stock market also. That was proved through Masala bonds. So bond yield refers to the expected earnings generated and realized on a fixed income investment over a particular period of time, expressed as a percentage or interest rate. So bond yield refers to the expected earnings generated and realized on a fixed income investment over a particular period of time, expressed as a percentage or interest rate. So bond yield is like the interest rate given by the bond and the capital appreciation over a period of time. When you purchase bond from the cash market, I will show you the bonds in the stock NSE. So this is NSE's bond market segment, and these bonds are traded in the cash market segment. This This is today's position, and the market was closed today 4 o'clock. And now 70 bonds advanced and 61 bonds declined, and total 230 bonds unchanged. And this is a bond, Britannia bond, and it's N3 series. There is series 9 bond type regular. There are bonds, tax free, regular, less tax. Tax free means it is exempted from tax, and regular means you have to pay tax for the interest received from the bonds. So there is an option for tax exemption and income tax giving some offer to the bondholders, so that many people, many taxpayers are interested to purchase bonds because they are getting tax exemption. So there are different types of bond under the categorization of income tax, tax free, less tax bonds. So these regular bonds means you have to pay for the interest received from the bonds. The coupon rate means the interest rate given by the bonds. So you can identify that the interest rate is lower and the face value and the last traded price is lower. So if the interest rate is high, you can see that a regular bond IFL and its interest rate is 10.5 and the face value is 1000 and is now traded in 1025. If you want to purchase this IFL bond, you have to pay 1025 to purchase this IFL bond, and you will get 10.5% monthly interest. And if you want to purchase 1 unit of IFL, you have to pay 1025, and its original price is 1000, and the capital appreciation is now derived is 1025. The person who purchased the initially, and if a person purchased 10 bonds means 10,000 he invested, but now his price 10,000 it's like 10,000 into means 25 price 25 rupees 25 has been increased, so 1025 into 10, that is the original value of the particular investor, and also he will get eligible for the interest of 10.5 percentage. So there are other bonds, DHFL. You can compare the bonds and you can purchase it. If you are interested, you can purchase these bonds through your broker. Okay. So any confusion that? So now you wanted, you need an insight that if the bonds interest rate is lower and its price value is also lower. This Britannia bonds interest rate is only 5.5, but its price you can identify that is 29.40 and the face value of rupees 29, and there is no demand at all because its last traded price is 29.40. Only 0.38% have changed this bond. Okay. So I don't know you are facing any confusions regarding this topic. Let me know any doubts. Otherwise, the class will be boring if you are not asking anything. So Sodhikumar sir, anything to convey regarding?
Sir, what? Yes, sir. What? I mean, if one take the holistic look, basically any person, for example, let's say a person has got 1 lakh rupees. I mean, you have mentioned about it in the beginning, but I thought I'll just clarify it. I mean, amplify it once again. If any person is having 1 lakh rupees for him to do some kind of savings, so it is always prudent for him to spread his 1 lakh rupees instead of putting all his money in one basket or one instrument. He generally should try and diversify his 1 lakh rupees so that he's covered. So these are the instruments that you have. I mean, if one takes these 3-4 instruments, let's say equity, mutual fund, bond market, and fixed income, or I would say the other way around. I'll start with fixed income. Next comes bond. Next comes mutual fund. Next comes your equity. So if one says that, and let's say fifth instrument also gold. I mean, okay, even if you leave the gold, these 4 instruments, these are basically there so that your risk is covered, so that you don't go into very high risk investments of equity alone and be vulnerable to losses. Instead, if you spread, the safest being the fixed deposit, which is probably giving you only 6% rate of interest or 5% rate of interest, but and your bond markets probably are giving you 7% or 7.5%. So as the percentage keeps increasing, the risk keeps increasing. So the higher the percentage, like for example, equity, you can tend to earn even 20, 25, 30, 40% also. But so is the risk. Same is the case with mutual fund. So I think if one can understand the perspective like that, that is the
Exactly,
reason why
you're
we are
right,
going.
sir. Right, sir. This is a very pertinent information you have, sir. Because some of the people means I would say the youngsters they are always interested, about the equity market only. They do not look for a diversified investment. So it's like a maturity of an investor. It shows the maturity of an investor, and it is like a diversified investment. And the equity portions percentage should be minimum, means less than 50%, because it is very risky. And that person should invest 50% in equity share. Maybe the 50% may be lower if he is interested, and is higher. It may be higher if he is interested, based on the risk perception of a particular investor. And also,
Again, sir, I
yeah,
mean, I'm sure it is a different topic altogether, but the risk appetite will depend on various factors like your age,
yeah,
your financial capability, financial sustainability, and other things. I mean, what is your risk appetite? Everybody can do is evaluation.
yeah, exactly right. So the the participants, the students in the class also definitely should have an insight that diversification of investment. If a person put all the money in the equity market, if the market crashes, all the money will be spoiled. So we have to diversify so that you are learning this kind of investments. So equity we have learned, now we are learning bonds, then mutual funds. So we have to be diversified investment, so that the risk can be minimal. Okay, so I would like to say that last month I have seen an investor and a person who is a retired fellow, and I wondered his investment, 80% of his investment in equity stocks. So, and I surprised that is all the equity stocks, means his portfolio is very good. So that kind of persons are there, but if that person's son was very confused, because his father is investing more on equity stock because he is a retired fellow. And what happened if the market crashes? So the son was he was not interested to put all these monies in equity market. But unfortunately, not fortunately, I surprised that his portfolio was tremendous, and it was performing like 30% up. So that kind of persons are also there. But in general, theoretically, we can say that, as Sodhi Kumar sir said, this risk perception is changed according to the age. If the youngsters are interested to take more risk, and so that, of course, they are taking more equity stocks rather than the bonds and gold and real estate or something like that. But if the age increases, the person's risk appetite may be changing, and he will reduce the portion of investment from the equity stocks to the bonds. So bonds are safe in the sense it provides fixed income and your principal amount is safe. But in equity stocks, your principal amount is not safe. If you purchase a bond, you will get the purchase price definitely, and also interest you will get. But if you purchase equity stock, if the company's stock prices is decreasing, it will not be refunded. Okay, am I correct, sir?
Yes, sir. Yes, sir.
Okay. So that this bond is very important, and the interest rate of some of the bonds are more than 10%. If you deposit fixed deposit in a bank, you will get only 7% in return. So some of the bonds are offering 9%. It's more than fixed deposit. You can find that. Okay, these are the bonds you can purchase from the NSE cash market through your demat account. So first of all, as a beginner, you can take a demat account. Now demat account is free. You can go with the Sharoda broking house is very good for the students and all. They are offering demat account free of cost. I think no brokerage at all. So there is your trading is fully free. The only thing you have to find some money, to purchase shares in the open market. Okay.
Sir, I don't think it is free, sir, but it is very low. It is, I think, 20 rupees per trade or
I
something.
recently learned some of my students opened account. It is free.
Okay, okay, sir.
Yeah,
Okay,
it
sir.
is free. Just a PAN card and a bank account is essential. And after that,
Yeah, but if it is free, sir, then I mean, opening probably is free, but probably to do transactions and to purchase and
no
sell, I think
brokerage, no
they will
brokerage.
charge you.
The transaction charges means they have means depository charges and then exchange charges only. Brokerage is
That's
free.
what, sir.
Brokerage is free. Means Sharoda is not charging at all.
Then I wonder how can they make a profit? I mean, they're not after all
Because
running a charity.
means the large crowd, trading at all. So after that, these people are trading with the derivatives and all, and they will get income.
Okay, sir.
They
Okay,
are
sir.
interested in the large segment of people, and they will get,
Okay, sir.
through Sharoda, some of the demat account, they will get commission from the depository and exchange also. They will be benefited from the
Okay, sir.
exchange because most people of their clients are trading. Okay. So characteristics of bonds. Some of the characteristics of the bonds include their maturity, their coupon rate, their tax status, and their callability. Several types of risk associated with the bonds include interest rate risk, credit default risk, and prepayment risk. It's already discussed. Most bonds come up with credit ratings that describe their investment grade. So when you purchase bonds, you definitely learn the credit rating of the bonds. Credit rating means the rating by an agency about the bonds capacity to repay your debt. If the credit rating maybe like triple A, double A, or triple B, double B, B or B plus, B minus, A plus, A minus, or something like that. About the credit rating. So when you purchase the bonds, you definitely check the credit rating. If the credit rating is triple A, you can definitely purchase the bonds because the bond is very good and there will not be any default risk at all. So bond yield measure their returns. So bonds are different types, corporate bonds. Corporate bonds are issued by companies that want to raise additional cash. You can buy corporate bonds on the primary market through brokerage firm, bank, bond trader, or a broker. Some corporate bonds are traded on the over-the-counter market and offer good liquidity. So before investing, learn some of the basics of corporate bonds, including how they are priced, the risk associated with them, and how much interest they pay. So that all very important matters should understand because information and knowledge plays very important in investment to get returns. So if a person means financial literacy is an important factor. So a person before investing, he should learn how to how to perform the assets, and pre knowledge is very essential. So when you purchase the bonds, you have to evaluate the company whether the company is performing good or something like that. So there are government bonds. Government bonds will be the best choice. Why? There are two reasons for it. Government bonds are issued by the central government in India, and these bonds are regulated and managed by Reserve Bank of India, so that these bonds are very liquid. Okay, so what makes government bonds risk-free is the security of the principal amount and the certainty of the promised return. And government bond, of course, it is the liquidity factor is very good. A person who wants to invest for a long term but wants to keep it risk-free, government bonds are the best option. So the government bonds are better than corporate bonds, I would say, because the risk factor is very low and the bonds are managed by Reserve Bank of India. So we can it is very safe to purchase government bonds. And this is a structure of government bonds. Central government's RBI is known as government bonds are known as government securities, and primary market and competitive bidding, non-competitive bidding. There are two options: competitive bidding, non-competitive. Non-competitive NSE Go Bid app. There is an app for the NSE to purchase government bonds by a common man. Okay. So government bonds, what are bonds and treasury bills? Bonds, government securities issued by the government of India to borrow money from investors who are investors. Big investors, uh, banks, insurance companies, mutual funds, trusts, corporates, etc. These are called big because of their size of investment in government securities are large compared to small investors. Small investors, retail investors, long dated government bonds holding time 5 to 40 years, treasury bills holding time less than 1 year. So these are about the government bonds. There are big investors also investing government bonds, and small investors like individuals and retail investors are also investing government bonds. And government bonds are long-term bonds holding time 5 to 40 years, and their interest rate, it is high. And treasury bills are also another part of government bonds. It is traded in the money market, and the holding time is less than 1 year. So if a person interested for a liquid money means short-term deposit, the person can prefer treasury bill. But I don't know. I would say that the treasury bills is not available for individuals to purchase. Treasury bills are traded through institutions. So all the money market instruments, individual cannot, I think, cannot access, but institutions can play with the money market instruments. So that's about the government bonds. So why wealthy people prefer bonds? And for wealth protection, it's the richest class are invested in bonds rather than equity shares because of the tax exemption given by the bonds. So their wealth is also protected because the principal amount is safe in case of bonds. So there is a municipal bonds issued by the municipal authorities like local self-government. They wanted, financing for municipal infrastructure, urban infrastructure, etc. So for that purpose, they are issuing municipal bonds. Unfortunately, Kerala, we don't find municipal bonds. Municipal bonds are, issued by North Indian, Maharashtra, Rajasthan. You can find municipal bonds for. They are usually issuing bonds for the urban infrastructure projects. So bond risk, there is a risk, interest rate risk, and reinvestment risk, default risk, and callable risk, inflation risk. These are the risk: inflation risk, default risk, callable bonds. Some of the bonds purchase, purchaser has the opportunity to call back the bond and repay back. If the bond, they wanted to repay back, every time they can have the option to repay back. So these are the bond risk. Bond market in India, two categories: retail bond market and wholesale bond market. Indian bond market. In retail bond market, trading takes place on the cash market segment. I already showed on the cash market segment, NSE and F group on BSE on the lines of share trading. So you can trade in bonds using relevant script codes on the normal NSE market and BSE market. Then wholesale debt market is played by the institutions. The wholesale debt market trading has separate segments for government securities and corporate bonds. So these bonds include fixed tenure bonds, tax-free bonds, taxable interest bonds, and perpetual bonds. And preference shares, which have fixed maturity period, are also traded in the corporate bond category. The wholesale trading takes place typically between institutions on the basis of negotiated prices. Indicative prices are fixed, first offered, and then the final price is negotiated and confirmed. It's about wholesale debt market. Some of the banks and financial institutions recently engaged with this wholesale debt market. You might have experienced a famous bank, Yes Bank, which was collapsed, and they have engaged with this wholesale debt market, and this interest rate and all depends on the negotiation between these institutions. And a lot of window dressing and a lot of off-balance sheet items are going on this wholesale debt market, and it is very risky play. And some of the banks were engaged, and these banks were collapsed. One of the best example was S Bank. This bank was played with the wholesale debt market, and they have suffered major losses, and their NPA was mounted because of this playing with the wholesale debt market. So it is not open to the individual. Okay, this bond market in India, I have shown the bond market. That's about today's classes.